Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. Today I'm going to be addressing a popular question that we get from clients, which is, can I open and fund a Roth IRA for my child, or in some cases my grandchild? And the answer is yes, you can. And it's actually one of the more powerful wealth accumulation strategies, because the way Roths work is you put after-tax money in, it gets to accumulate tax-free, and then as long as it's withdrawn after age 59 and a half, you actually receive all those earnings tax-free as well. So if you have a child or grandchild age 20 and they have $10,000 in a Roth IRA, and with no other contributions, if that accumulates for 40 years and it gets 8% per year, there's about $217,000 sitting in that account 40 years at that point that they can withdraw all tax-free. Three of the topics that I'll be covering in this video are the contribution limits to these accounts, which are a little bit trickier with these child-funded Roth IRAs. I'll be covering who has control over the account, which depends on the age of the child, and also some advanced withdrawal strategies. First, let's look at the contribution limits to these accounts. So if you're funding one of these accounts for a child or grandchild in 2022, the contribution limit is the lesser of $6,000 or what they had in earned income for the year. And it's actually common that for children age 15 to 21, that sometimes their earned income is below that threshold because they just have part-time work or they're working just during the summer. So you actually won't know how much you could contribute for them until they have their W-2s at the end of the year that says, this was my total income. So an example would be, if you have a child that works during the summer and makes a total of $3,500 for the year, that is the lesser of, so the max Roth contribution you can make is that $3,500. Now let's talk about who has control over these Roth IRAs. So if you're funding this for a child that's under the age of 18 or a grandchild under the age of 18, you're typically opening what's called a custodial Roth IRA, which means you have control over the investments, you have control over the withdrawals out of the account until they reach that age of majority. At age of majority, that's when essentially the child has full control and they could distribute the full balance if they wanted to. If the child is already over age 18, normally they're the ones that have to sign all the forms, fill out all the paperwork, and it's not a custodial IRA, it's actually just a Roth IRA, and you just happen to be providing them with the funding mechanism. The contribution deadline for these child-funded Roth IRAs are the same as any other type of IRA. It's April 15th following the tax year end. And typically with these accounts anyways, you're again waiting for their W-2s to find out how much you're going to be allowed to contribute to the Roth for them that year. The other question we'll sometimes get from clients is, does the child need to file a tax return in order to be able to fund this Roth IRA? And the answer to that is no. As long as their income is below the threshold that would otherwise require them to file a tax return, they don't necessarily need to file a return just because a Roth IRA contribution was made. One more note about contributions before I move on to the distribution strategy is the contributions have to be aggregated for purposes of the annual dollar limit. So assuming the child made enough to put in the full $6,000, if the child is contributing to their Roth and you want to contribute to the Roth, you have to coordinate those contribution amounts because they can never go over that $6,000. It's not like the child could put in 6, you can put in 6. It's an aggregate amount for the year. These Roth IRAs can serve as a dual purpose to the child, because while I may want to help them jumpstart their retirement savings, there may be other things I don't want to help my child or grandchild fund, like maybe a future down payment on a house or to put money towards a wedding. So if I'm putting in, let's say, $5,000 a year for 4 years, that's $20,000. That $20,000 is always going to be available to them to be withdrawn tax and penalty free, maybe when they get a house 10 years from now, and they can always just leave the earnings portion in the account and let that accumulate tax and penalty free, and then would withdraw it tax free in retirement. While I've been talking a lot about children and grandchildren, you can really fund these Roth IRAs for whoever you'd like. If you had a niece, if you have a nephew, if you have a brother, if you have a sister, like as long as they meet the income criteria to allow them to contribute to a Roth IRA, then you're eligible to essentially give them the funds to make that contribution. An advanced strategy for business owners is sometimes the business owner will put their children on the payroll for the sole purpose of producing a W-2 that's enough for them to max out their Roth deferrals each year and make those contributions. But just a word of caution that if the IRS or DOL ever comes knocking and questions it, you just got to make sure you're comfortable proving that they did provide services to the company. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.